but not a huge rush. So we'll go ahead and get started here. Let me get the screen shared. Can you guys see that okay? Cool. All right. So hopefully you're here for the January real estate update. If you're not, obviously welcome to stick around. A little bit about me. I think I ran through here. I think everybody pretty much knows who I am, so I won't spend too much time on this. But as you guys know, I definitely have a passion um, for numbers and data, and I love to share and present as well. So every month I'm here doing this. I try to find some interesting stuff. I will tell you, although there's definitely interesting stuff that happened today with rates. December tends to be a little bit of a boring month just because of the holidays and everything. Not a bunch of policy stuff. And Emily Tapman, you can just go ahead and turn that camera off right there. We don't need to see all that. So,
Sorry,
um,
tried to be
no, I'm just kidding. She's down in the Dominican with sunny blue skies, and I'm sure warmer weather than we all have. So, um, but yeah, so every month, we're a little off on our timing. I think we're usually the third Monday of the month, but because next week is a holiday, we are here a couple days early. So, I am more than happy to share the slides as well. So if you're interested in the slides, I'll give you my email at the end. And I'm happy to share the slides. You're welcome to rip off and duplicate using your listing presentations, buyer presentations, whatever. There's going to be um, no hard feelings from me on that. That's why I do it. So, all right. So I'm going to go ahead and get started. Here comes all the late people all at once here. What are we at? 5 minutes in? All right. All right, let's go. So what we're going to focus on today, we're going to talk a lot about rates. Um, just because I feel like out of anything that's driving the market over the last couple of years, rates are definitely that. And that's, I would say, the piece of news that has brought the most excitement here since the new year. We'll talk a little bit about mortgage applications, which are really a byproduct of rates. And then we'll go through inventory and selling trends nationally. And then we'll jump into Central Ohio. I think most of you guys are in Central Ohio, but obviously, if you're not and just interested, feel free to stay on. If you have other stuff to do and would rather not, feel free to jump off. So, all right, like I mentioned, this is something that's a passion for me. I really feel strongly, and I think you're existing in the market that we're in currently, it's super important to have a differentiating factor and to really understand the market at a high level. Because even though we're going to talk about the market on a relatively macro level today, even obviously when we talk about national numbers, but even when we go into local numbers, there are properties going on the market that went on the market last week that got multiple offers and sold for tens of thousands of dollars over list price. And there are also properties in Central Ohio in a different neighborhood, sometimes the same neighborhood, that have been sitting on the market for months. And so the goal of this conversation is really to give you some ammunition in conversations with both buyers and sellers to be able to either move the buyer towards a buying decision, or to help the seller price and present properly. And I think more than ever before, the last 12 to 24 months has been an extremely skill-based market. And that's been very different than the previous, 3 or 4 years. So if you've been in real estate for less than 5 years, you've probably seen a little bit of uncomfortable feeling around maybe past experiences versus the market of the moment. And so my goal is to help bridge that gap as much as possible. I love interaction. So if you have questions, please don't hesitate to unmute and speak up. Feel free to type it in the chat as well, but I'm less effective at seeing those at the right time. So if anybody else sees a question and you're too shy to unmute, I know there's several people on here that I know shy is nowhere in my description of their personality. So you guys need to pick up the pace and unmute and let me know that there's a question. So, all right, let's jump into interest rate. So this is a 12-month look. Now, I literally just updated this about 10 minutes ago because Mortgage News Daily did their afternoon update. But one thing, it was looking a lot worse yesterday than it is today. So you can see that we had bumped up last week, and that was a result of the jobs report coming out on Friday, much stronger than expected. And to put all of this in a nutshell with regards to why interest rates are so volatile, ultimately, if inflation doesn't keep going down, the Fed is less likely to continue cutting short-term interest rates. And when the market doesn't believe that the Fed is going to cut rates more or as quickly, they push they push up the long-term rates. And I don't want to get into all the weeds on why that happens, but in general, when you have stronger than expected jobs reports or higher than expected inflation reports, that's typically going to push rates up. Obviously, when you get the opposite, it pushes rates down. And so here in the last 5 days, we've had both. So on Friday, the jobs report for December came out. It was much stronger than expected. That pushed rates up like close to a quarter of a point in just one day. And then yesterday we got a producer price index, which is basically what it costs a company to make a product, was lower than expected. That really didn't move the needle much. But then this morning, the consumer price index, which is actually what consumers are paying, also came in lower than expected. And so that is what the Fed primarily uses or looks at to decide whether inflation is going up or down. And it basically showed a trend that in spite of more jobs being created, inflation was down. And so that's good. Actually, more jobs and lower inflation is really the best case scenario. It's unlikely to be a super long-term trend, but definitely the best case scenario. So we'll kind of zooming in a little bit more to just the last few months. Well, let me go back to that slide really quick. So you can see that we're not quite at yearly highs. Last spring, we saw rates spike quite a bit, which kind of started the general slowdown. But then you can see we kind of bottomed out in September, October, and then we're back up over 7%. If we zoom in to just like the last 4 months, we kind of show that bottom in September. And then you can see that at least we've just today, with the steep drop after the inflation report, we're at least back to where we've been since about the middle of December. Certainly, we would love it to keep going down, but at least staying closer to that 7%. I think we've talked about this a lot, that local lenders are usually lower, and I've got a little slide on that coming up as well. So this is the 10-year Treasury, which if you want to follow something, Mortgage News Daily is good enough, really. But if you want to be a data nerd and you want to know what's happening by the minute, typically the 30-year fixed follows the trend of the 10-year Treasury. And so you can see the market really, really liked that inflation report this morning. And then this is what happened on Friday when the jobs report came out. So you can see the market moves really quick. I pulled this from CNBC. If you just Google CNBC 10-year Treasury, they have really good interactive graphs. Again, probably most of you aren't as big a data nerds as I am. So you can go on at any moment and watch this change basically by the second, if you want to kind of know the trend. Now, that being said, mortgage rates definitely don't change that quickly, typically, unless there's a drastic move upwards. Usually rates take, a couple hours to a half of a day to reflect major moves in the market. So Just another way to look at the moves today. So the average interest rate on a 30-year fixed across the country was down a little over 12 basis points or 0.12% compared to where it was to start the day. So pretty good move. But yesterday, like I said, we jumped up about that same amount. So kind of giving back. Here's a local rate sheet. Thank you, Equitable Mortgage. So since they send it to me, I give them the free publicity. But you can see, I would say that most local lenders are still under 7. Now, this was Friday. I think rates jumped a little bit more yesterday morning. This is probably kind of on par with where rates are back to, maybe a little bit less by the end of the day. But again, you can see the national average is about 7.15 and we're about 6.875. So typically we see in Central Ohio around 0.25% difference between what we see on Mortgage News Daily and what you can get locally. But obviously credit score and points and all of that stuff definitely plays into that conversation. Mortgage applications, not a ton of new here, but obviously with the rising interest rates, you can see that there are a lot fewer buyers applying for mortgages. And so, as we all know, demand and accordingly, sales are down compared to where they were during the pandemic. Same thing with refis. This is just the last 12 months, but it kind of shows when rates dropped in September, there were a bunch of people that had gotten mortgages at higher rates that were taking advantage and refinancing. So again, if we do see rates drop, I'm always looking for ways that we can re-engage those people that are in our pipeline that have maybe stalled out. So one text you can send today is the inflation report came out and most likely there's going to be downward pressure on interest rates. Do a screenshot from Mortgage News Daily and send them the zoomed in picture of the fact that rates have already dropped on average today, right? Those are easy ways if somebody's kind of dropped off over the last couple weeks, to re-engage them being a market expert. All right, so on to national numbers. Again, these are going to be primarily centered on the month of December, actually, as we go through local as well. We've got a few month to date stuff. But active listing count, you normally every year you can see that typically in November, December, we see the number of listings go down because people that haven't sold tend to take their house off the market. Savvy agents who know the MLS days on market will reset if it's off the market for 30 days. We'll take it off in the middle of December and put it back on in the middle of January. I would not be surprised at all if we saw a pretty good bump in listings this week for that reason. So that'll remain to be seen. But yeah, so active listing count was down compared to November, but it was up 22% compared to 2023. So as I'm sure you guys know, the number of available listings is definitely higher. The interesting thing is newly listed homes was definitely down. So we were right in line with the last couple years, but definitely still well below basically pandemic and pre-pandemic numbers. So you still have fewer sellers that are willing to list and sell that 3% rate. Pending sales were right in line with 2019, which is interesting. They're the highest that they've been outside of 2020 and 2021 in the month of December. So again, a good sign for the number of closings that will happen in 2025, but also an indication of kind of the obvious, but basically the more inventory we have, the more homes we're going to be able to sell. And I think that's coming out in the pendings data. Days on market, though, 9 days more on average than last December. So, as I'm sure you guys all know, on average, there's definitely more homes sitting on the market. And again, as we zoom into Central Ohio, we'll see that, in a more applicable way. But certainly, if you're on here from anywhere else, I think across the country, we're seeing that. Some areas more than others, but for the most part, everywhere at this point. Median listing price. Now keep in mind, this is the listing price. And I don't have the chart for the national data, but what I can tell you is locally here in Central Ohio, and we'll look at this in a few minutes. But we are seeing the average list price go down while the average sales price is actually trending up. Um, and so to me, what that says is that sellers are getting more realistic about the market of the moment, and agents are also getting better at pricing. Again, when we talk about that, any agent that's been in the market for less than 5 years, the last 12 to 18 months has probably been a little bit of a shell shock for you. I can tell you in my almost 21 years, which is crazy to say out loud, I don't think I've ever experienced a market that was so difficult to price in. Again, like I started off, I mean, when you can have one listing go on the market and receive 10 offers, and then another listing go on the market and get one showing, all in the same week in the same general market, like that's crazy. And that's what's happening. So it's super important that you dive into that local neighborhood market and understand what's happening right there when you're recommending pricing. Price reduced share, you can see it's high-ish, I would say. It's not really, it's kind of right in the middle of the last several years, which tells me that again, it's another sign that we're falling into a little bit more of a balanced market. I also think the reason this was really high last year. So for most of the year, we were kind of higher than almost all the years. And then at the end of the year, we dropped in. I think that's really an indication of sellers just becoming more realistic on pricing and still lower than average inventory, even though inventory numbers are up, we're still lower than average. And so that's also leading to some sellers kind of holding on to those prices and not being willing to do reductions. Regional stats, not a lot of significance here, again, unless you're kind of a data nerd. But what we are seeing is that some of the areas that were the hottest, we're continuing to see that the areas that were the hottest during the pandemic are actually seeing, stronger slowdown. And largely that's just due to extra supply. So you can see that the South and the West are up, 25% year over year. And these are obviously the whole region. So in Columbus, we're actually up more than 15%, but the whole Midwest as a whole is only up 15, Northeast is only up 7. And so because of that, the median list prices are kind of holding firmer, I think, in the Midwest and Northeast. But I also think the Midwest and the Northeast didn't see as much appreciation during the pandemic. And so it kind of levels itself out. And I think there was way more supply built in the South and West. And so they're working through that. All right. Before I jump into Central Ohio, does anybody have any national questions, comments, anything that you guys want to discuss? No? Don't everybody talk at once. All right, sweet. All right, Columbus or Central Ohio. So, looking at December over December numbers, basically everything was up. So, the number of properties for sale was up 20, almost 24%. The new listings was up over 9. And then the number sold, which is again good for all of us, was up over 11%. So, that those are all good trends. And to me, it's an indication that we should expect to see more homes sell in 2025 than we did in 2024. I think the reality is that more inventory is definitely opening up the possibility, especially in the lower price points, that some first-time buyers that have been sitting on the sidelines who couldn't do appraisal gap coverage and didn't want to buy a house without an inspection, are now able to make an offer without being in a super competitive situation. That's obviously not true in all areas, but it's definitely true in more than we've seen over the last 5 years. This is just breaking out the difference between resale and new construction. To be honest, typically, as you can see just from looking at the numbers, the lion's share of the data is coming from the resale market. So usually these numbers are the same. But one interesting thing we're looking at here is the month to date numbers. Like I always tell you guys, the day of the week does factor in here. Meaning like if the 12th, what was the 12th? Monday? So on Monday, there's definitely going to be the highest number of properties listed for sale that haven't been marked contingent yet from the weekend. And so these numbers may be skewed a little bit, but they're definitely not skewed 50%. So, I mean, you can see that last year on Monday, we had just under 2,000 listings on the market. And this year we had 3,100. So, around 50% more listings on the market. An interesting number, and again, this could have to do with the day of the week, but I think it's probably not. So far, month to date, we have had fewer new listings hit the market. So that's interesting compared to last year. So we'll see if that continues. I think there's a lot coming out today and tomorrow in terms of coming soons. So that may catch up with that. New construction, fewer new listings, but as you guys all know, new construction doesn't list all their properties on the MLS. So yeah. All right, days on market. So days on market has continued to trend upward, as all of you guys are probably aware throughout the year. The one interesting thing, we're kind of holding steady at 96% of original list price is what we're selling for. So it'll be interesting to see how that changes or not. But I do know from talking to several people and then being obviously involved in the market myself that there's definitely, especially for those listings that have been sitting on the market, there's definitely some wiggle room for a lot of sellers, not all, but many sellers have a lot of equity built up over the last 5 years. And especially if they've already bought another house thinking that their house was going to sell right away, they may be more inclined to negotiate than you might be used to. So if you're representing buyers, definitely just look at days on market, look at what's happening in the neighborhood, have a conversation with the listing agent, and really probe and try to find out, what the seller's motivation is, because I definitely think there's some opportunities out there to get a lower price, sometimes significant. Month supply did back off a little bit last month. Again, I think that's more of an example of people taking their house off the market, and then a lot of places that had been pending closing, then it is an indication that the market sped up, especially with rates rising. So I'm anticipating that this month's supply number will increase the month of January, barring some crazy change in rates. You can see when we look at kind of a longer out view, that it's really been since the end of 2018 that we've had this much supply in the market. So if it feels like there's a lot more homes to show, it's because there is. Especially when you go back to 21 and 22, you can see when we got down to like a half a month supply in the whole market. Again, new construction, because not everything gets listed, a little bit less valuable in my opinion. You can see that new construction number of listings went down last year in January as well. So I would say that that's, again, just a normal trend. Average sales price, this is what I was talking about. So year over year, in terms of the average sold price in December, we were down for the first time, I think for all of last year. I don't think we were ever down in month over month. What I will note on this though is that you can see the trend line this year was like pretty consistent. And you can see last year there must have been a really big sale that happened in the month of December, because I know that we didn't have like this crazy strong November that created a higher price in December. So you can see if you would have followed the trend line, sorry, this isn't a perfect, but if you followed the normal trend line, you would see that we would have been well below. I'm not sure what happened there in December. But I would anticipate that we will see January be above last January. And you can see also that the gap, and I think I talked about this quite a bit last month. Sorry again for the mouse drawing artistic ability there. But you can see the gap between the list price and the sold price really shrinking. And again, I think that's a real indication of sellers being much more realistic with their prices. But we're still seeing, again, outside of the month of December, we're still seeing the average sold price continue to go up in Central Ohio. Um, and that's mostly just due to a continued lack of supply. One thing, I don't know if any of you guys were, probably none of you were at it, but I don't know if any of you jumped online. But I jumped onto the Columbus Metropolitan Club, had a luncheon today. Buffy Patterson, our Columbus Realtors president, was there, along with a BIA rep, and then also somebody from MI Homes. And they were really talking about, supply in Central Ohio, what are the challenges, all of that stuff. And a super interesting stat. They said that the average new build in Central Ohio is now above 500,000, which is crazy. That, and then also our average resale price, as you guys know, is like in the high 200s, I think low 300s. That is higher than Raleigh, North Carolina, Nashville, Tennessee, and Indianapolis by a significant margin. And the biggest reason for that is Indianapolis built 19,000 new homes last year, and we built 11. So we built almost 50%, 40% fewer homes than Indianapolis, which is almost the exact same size as us. As you guys know, it's just west. It's the state capital right in the center, basically demographically very similar. Um, and so we're quickly falling behind on supply when it comes to new construction. And so, obviously the city of Columbus is doing a few things zoning wise, but there are definitely a lot of challenges. So I know this isn't the purpose of this meeting, but I would encourage you guys, if you have any desire to get involved in anything, make sure that you're going to your local zoning meetings. And then also, when it comes time to vote, voting for people who are going to be friendly to development, because we're going to be in a really big, we're already, to say that we're more expensive than Nashville is crazy to me. And it's all because we're just not building enough. And the BIA guy said, I mean, this has been a trend for the last, 15 years, that we've been well below the average of all of those like similarly sized cities. And, basically what they said was if the prices keep going up, it's going to start to limit growth, because one of our advantages has always been affordability. And so we'll start losing to Indianapolis and losing to Raleigh when it comes to new companies coming to town, because they're looking for that affordable housing. All right. Allison, you sent this to me and I forgot to update it. So sorry about that. All right, this is the last chart this is one that we build in-house. I think it's super powerful when you're talking to sellers. And it's a really good indication of where buyer demand is. All of this data comes from showing time. So you can build one of these yourself, obviously, for a specific area. But one interesting, or the interesting conversation point here is that we're starting off the year this year with fewer showings than any of the last 3 years before now. So in the last 4 years, this is the slowest first 2 weeks in terms of total showings that we've had. And so again, I don't know if that's a trend, if it's a blip in the radar. Obviously, the weather has been really bad, which for those of you that have been in real estate long enough, is silly as it is. Cold and snowy weather does keep buyers, home. So we may make up for that as we get towards I mean, I guess the next few days aren't going to be any better, but maybe as we get towards the end of the month, we'll warm up a little bit. But this is definitely something I'll be watching. And I think if this trend continues, we'll continue to see inventory rise. But I think this is also a chart that you can send buyers who are on the fence about making a move and say, like, look, you guys are missing out on an opportunity right now to jump into the market when competition is the lowest it's been in the last 4 years. So this is just another one of those things. I encourage you guys to, steal this stuff, use it to get your people into action or to get sellers to price correctly. And then, as I've mentioned in past months, you can also use this data to decide when in the spring you want to list your property. Again, just to kind of reiterate, because I think it's important. Typically, we see the peak in buyer activity as represented by showings to be sometime in middle to late April. So as soon as you get past middle to late April, you're dealing with a declining number of buyers in the market. And if you look at the number of new listings annually, typically you see that peak in the May and June timeframe. So if you're listing in May and June, and again, this is market wide, so there's going to be some suburbs, especially suburban school districts, where things are probably going to get shifted towards May a couple weeks. But for the most part, if you're listing at the end of May, beginning of June, you've missed the best time to list. And so I would highly encourage sellers to get ready in the market and be ready to go on the market by mid to late March or early April at the latest. Um, and then you can keep an eye on data by coming to this class every month and or this presentation and see if the data is still trending in the same direction as it has in past years. Or obviously you can go on Showing Time and look for yourself. But ultimately, if you don't use anything else in this presentation, my advice to you would be to print this off and have conversations with every seller about this data. Because as you can see with 3 years of data now, the trend is undeniable. Um, that 2022 year was crazy because interest rates were rising. But you can see 23 and 24, and even the trend in 22 was still the same. So, all right, last but certainly not least, rentals. Um, Rentals are not exciting right now. Having a couple got a little pop here after the first of the year, but definitely rental demand is definitely down compared to where it was a year or two ago. I wouldn't say prices are declining unless you're really desperate to get somebody in, but certainly, being able to recoup the insurance increases and property tax increases over the last 12 to 18 months is not happening in the rental market. So we've kind of reached a ceiling. I think part of that is there was a ton of multifamily construction that went online over the last 12 months and probably will through the first half of this year. That's kind of suppressed. The big guys will do whatever it takes to fill those places, including giving free months and all kinds of incentives. And so, not to say that if you have a single family, you're really in competition with them, but the overall trend in the market, pushes down rents or holds them at least steady. So, all right, and then sources, pretty typical. I don't think I added anything else this month. So all those graphs come from Trend Graphics. If you're at consultants, you have access to that stuff. The national stuff comes from Realtor.com, and then the rental info comes from Zillow. Mortgage stuff comes from Mortgage News Daily. So. All right. Well, that's all I've got presentation wise. I told you guys it was going to be a little bit light this month due to the holiday and just a lack of exciting stuff coming out. But what else? Questions, comments, concerns, any anecdotal info that you guys have that you want to share? No, you guys are quiet today. I feel
Okay, I
like
have a quick question, Troy.
all right.
So just because I'm getting asked this, like how much of an impact will January 20th, like an inauguration day, like have on rates? Like will we see anything instantly, do you think? Or like what's your prediction?
I mean, I am very cautious to predict anything with mortgage rates because I think people that have been a lot smarter than me have um, failed over the last couple of years. That being said, I think that any short-term changes are already baked in, meaning that, the market is predicting what's going to happen already, if that makes sense. I think what could happen as a result of January 20th is if there are policy changes. The biggest thing I think that could have an impact quickly would be if the new administration wants to extend I think it was 2017 tax cuts, which are set to expire this year. If they're able to do that, that keeps more money in the pocket of businesses, which the market is going to think is a good thing because that means they have more money to invest, which means that stock prices technically, theoretically, are going to go up. Um, but I think the big question that's hanging out there right now, which isn't going to get answered on Monday, is some of the policies that Trump has proposed are could be construed as inflationary. Now, obviously, he says that more oil, lowering the price of oil, all that stuff is gonna offset any increases that happen as a result of tariffs and things like that. All of it is speculation at this point. I don't I guess that would be the one thing that could happen if he were to enact immediate tariffs. That could be bad for interest rates. Honestly, if out of all the things I've heard, I think that's the only thing I've read is that if tariffs were enacted immediately, it seems like the market believes that that's going to create inflation. And I think the drilling and all of that stuff, which could limit inflation, is going to be something that happens down the road. And so I would say if there's any effect, it's probably going to be higher. But my prediction, which do not take this to the bank and don't share this with your clients, this is not written in stone by any means. But my prediction is that things are probably just going to be pretty vanilla. I don't think, unless he comes out and says, I'm applying a 25% tariff on Canada or something like that. Um, I just don't see anything happening. The one thing that I think is even more of a stabilizing effect in the last 24 hours, there's been a lot of news that Israel and Hamas have at least reached some sort of a tentative agreement on the release of hostages and things like that. I know that was something that he publicly said he was gonna get more involved in that conflict if it wasn't resolved. Obviously, I think the intention was to get it resolved. If we were to get more involved in that conflict, that could push rates down. But as of this moment, and I haven't even really looked at that news this morning, but assuming that that gets resolved in some way, I think that just causes a stabilizing effect and probably doesn't do much in one way or the other um, to change it. So. I know that was a long answer, but nobody else is asking questions, so I figured I'd take the time. Anybody else have
I
any?
Troy,
appreciate it.
yeah, and Troy, I did just see a push notification that a deal was reached.
Okay. So yeah, that was pretty accepted last night. And obviously, as we know with those kind of deals, like deal in principle and then deal in actually execution are two different things, but it sounded like everybody involved was pretty positive that that was going to happen. So thanks for the update. Anybody else?
I just want to give a quick shout out also to Celeste, my referral partner in Charleston, South Carolina, who hopped on today. So, hey, girl.
Nice. I know Celeste kind of enough to say I know her, right, Celeste, I think. Thanks for jumping on. Anybody else have anything?
Yeah, I've been trying to, thanks, just thanks for having me, Emily. Thanks for inviting. Sorry, I'm on my phone, and so it was like another screen to say hi, but tons of value, and thank you so much. I'll be here moving forward.
Cool. Thanks. Feel free to share.
I was just looking on Showing Time, trying to figure out how to pull up that report for listings in Columbus. Would you be able to share how to do that? Because within the reports, it kind of looks like it's mostly focused on like my actual listing activity and showing activity.
Yeah, since we have time, let me get to it so I can give you the exact way.
Cool.
And if you email me too, I can send you, if anybody wants it, I have a Loom video on how to run these, so I'd be happy to include that with the slides. But basically, when you go into reports, you go all the way to the bottom to target market analysis.
Mm-hmm.
And then that pulls up a screen that gives you the ability to like filter all of that stuff. And you can set date filters. You can also set price ranges, and then you can also do individual zip codes or subdivisions as well. And so that's how we got that. We just go week by week and pull that data. And if you press submit, then you'll see like at the bottom the number of showings that happen. So yeah, does that make sense?
Yeah, so you guys are creating a separate report based on the data you pull from there.
Yeah, so that graph that I have that I shared is completely created manually by us.
Oh, okay. Got it.
Yeah.
Great.
Using that report to build it.
Makes sense. Okay, thank you.
Mm-hmm. Anybody else? Anybody else have any anecdotal or real world data in terms of like listing activity or buyer activity or anything like that that you want to share? New build activity? No? My normal victims that I pick on aren't here, so I'll try to be nice, especially to all of you that might be new, not call you out. All right, cool. Well, we will, if you want to email me, it's troy@marshhomegroup.com. We will get the slides over to you, and then we can also add you to our calendar invite, so that way you don't miss it in the future. So just include that, and then also if you'd like the Loom video on how to run those reports and showing time, please include that in the email, and Allison will get both of those things out to you probably today. So thank you guys for showing up, and you're welcome for the extra 15 minutes that I just gave you back. Have a great day.
Thanks, Troy.
Thank you.
Yep.